All right, let's pull back the curtain on a market dynamic that might, just might, explain some of those traits that made you want to pull your hair out.
So let's just dive right in with a question that I'm pretty sure every single trader has screamed at their screen. Have you ever felt like the market knows exactly where you put your stop loss? I mean, you place a trade, you set your stop, and you just watch in total disbelief as the price moves just far enough to tag you out, only to immediately reverse and rocket in the direction you predicted all along. Sound familiar?
Well, what if I told you that wasn't just a run of bad luck? What if it was actually by design? In this explainer, we're going to dig into a model that suggests these incredibly frustrating moves are actually part of a deliberate three-act play, all orchestrated by the market's biggest players.
This whole concept is known as AMD. Now, that stands for accumulation, manipulation, and distribution. You might also hear it called the power of three, and that's just because it breaks down market moves into these three very specific phases. Think of it as a framework, a kind of playbook that traders use to try and understand how those huge institutional players, the so-called smart money, actually operate.
So the key thing to get here is that this isn't just random, chaotic price action. No, it's a model that describes a really methodical process. First, build a position. Second, trap retail traders to create liquidity. And only then, after all that setup, launch the real intended move in the market.
The whole pattern really does unfold in three super distinct phases. It's almost exactly like a theatrical play. You've got your three acts, and each one has a very specific purpose. You really have to understand each act to see the whole strategy for what it is.
All right, so let's start at the beginning. Act 1, accumulation. This is where the stage is being quietly, almost secretly, set for the main event.
Now, what's so interesting here is how this model completely reframes that slow, boring, sideways price action that we all see. You might think it's just the market being indecisive, right? But according to this theory, it's not indecision at all. It's actually a super calculated first step. This is where those large institutions are quietly building up their positions, buying or selling, and in the process, they're creating these really obvious support and resistance levels, and you better believe those levels are going to be used against other traders later on. And that brings us to the most deceptive, and let's be honest, often the most costly phase for so many traders out there, manipulation. This is Act 2. This is where the trap is finally sprung. The key move in this whole phase has a name that is just perfect. It's called the Judas Swing. I mean, how great is that? It just brilliantly captures the treacherous, backstabbing nature of this move. It's a move that completely betrays all the expectations that were so carefully set up during that first accumulation phase. This is the move that feels like a personal attack. You know the one. It's that sharp, sudden spike that's engineered to do two very specific things. First, it's there to stop out anyone who is already in a good position. And second, it's there to trick breakout traders into jumping in, but going the complete wrong way. See, both of those actions create this massive pool of orders, what we call liquidity. And that is exactly what the big institutional players need to fill their absolutely huge positions.
So after the deception, after all that liquidity has been cleverly engineered, now comes Act 3, distribution. This is the big one. This is the powerful, aggressive trend that the smart money was planning to unleash all along. And this right here, this is the payoff. Think about it. Everyone who was on the right side has been shaken out. Everyone who jumped in late is now trapped on the wrong side. The path of least resistance is now wide open. So the market reverses, often sharply, and makes its real move, leaving a whole lot of traders behind just scratching their heads, wondering what in the world just happened.
Okay, so this is all great in theory, but how can you actually spot this playbook in action? Let's take a look at what traders look for when this pattern unfolds, both in an uptrend and a downtrend. The real beauty of this model is how symmetrical it is. So for a bullish move, what are traders looking for? Well, they're anticipating that Judas swing to be a sharp drop below the consolidation range. That's the signal to potentially get ready to buy. And for a bearish move, you guessed it, it's the complete opposite. They're looking for a sharp spike above the range as a signal to maybe sell. The three-act structure is exactly the same. The only thing that changes is the direction.
All right, before we wrap this up with the key takeaway, we absolutely have to talk about risk. This part is super important.
Look, it's absolutely critical to be realistic here. This is a theoretical model, it is not a crystal ball. Trading is inherently risky, and no pattern, no matter how good it looks, can ever guarantee an outcome. You should always use proper risk management. Remember, everything we're talking about here is for educational purposes only.
So if there's one single thing you take away from all this, let it be this. Those sharp, sudden moves against the trend, they often aren't random. They have a purpose, and that purpose is to engineer liquidity. Just understanding that simple idea can completely change how you look at a price chart.
And I want to leave you with one final thought. When you start to see the market less like a random walk and more like a structured story, you start to see patterns everywhere. So if this pattern exists, what other stories might the chart be trying to tell you? Thanks so much for joining me for this explainer.